Well, good afternoon, shareholders and investors, and welcome to today's Plato Income Maximiser webinar. My name is Amelia McKinnon, and I work in the listed products team at Pinnacle Investment Management. Just a quick reminder, Pinnacle are equity partners and work alongside Plato to distribute their investment strategies and listed investment company, Plato Income Maximiser Limited, with the ASX ticker code PL8 to the market. With the goal of keeping our shareholders informed, today I'm delighted to be joined by Dr. Don Hamson, the Managing Director of Plato Investment Management and Director of the Board of PL8, to update you on the board's recent decision to reduce their monthly dividend to 0.4 cents from 0.5 cents per share commencing this month, a level the board feels is prudent in light of the rapidly evolving economic situation. Don will also provide an update on the current COVID environment and address the outlook for Australian company dividends. Don's presentation will last for around 20 minutes, with 10 minutes at the end for Q&A. All attendees have the opportunity to ask questions, which can be done by clicking the Questions tab on your screen. So without further ado, I will hand you over to Don to talk you through today's presentation. Thank you, Don.
Thanks, Amelia, and welcome fellow shareholders. It is certainly a different environment that we live in now as only a few months ago. Things have changed very, very rapidly, and today we're going to look at some of those changes. Probably we first should look at the important disclaimer so that you understand what we're talking about, but the usual disclaimer is there. But as Amelia has said, we want to talk about what's happening. And one of the first things I just wanted to let you know is this webinar is very similar to the one I did a couple of weeks ago with Peter Gardner. So if you listen to that webinar, you'll find there's a lot of overlap, but I'm sure that some people didn't listen to that webinar, in which case we'll really go through the environment that we're sitting in. Firstly, if we look at what's happening at Plato, it's pretty much business as usual. I mean, we are all working from home, but we are using all our normal systems. We did a full test of those systems early in March, and we've been working from home since March 16. So I think it's now about week 5 or 6. And in fact, some of our team were working from home the previous week. We manage money on behalf of a wide range of clients, and despite a lot of discussions about flows and liquidity and things, we've actually seen no real net outflows. In fact, as of this week, we've actually seen more money coming in from our clients than we've actually paid out. Only had a couple of very small outflows. So our business is very stable, and we have a very highly experienced team who are all safe and well. 11 staff in the Plato team. We've all been working through periods like the current situation. All of us worked in the financial markets in the GFC, and I won't say I'm happy to say that, but I was also here in the last technical recession that we had to have. So there's a lot of experience within the Plato team, and we've been doing quite a lot of work just checking how our stocks we own will perform in the current environment. It's important to note that our portfolios by design are very well diversified and very liquid. We've always said it's better to own a diversified portfolio of income stocks rather than just a handful of stocks. So moving to the environment and what's happening. First thing is, we've been saying that interest rates are going to stay low for a long time, or lower for longer, and indeed that central view has been reinforced by what's happened around COVID. We've seen central banks around the world where they had scope to lower interest rates, so that's in the US, Canada, Australia, New Zealand, and the UK, have lowered interest rates. Here in Australia, we've had 2 cuts to 25 basis points, and we don't expect that to go any lower. Indeed, the market is expecting rates to stay on hold at 25 basis points for the foreseeable future. And this had been sort of telegraphed in terms of even prior to COVID, that interest rates would stay low for a long period, for an extended period, in the words of Philip Lowe. But we now think that that's even lower, whereas interest rates to 75 basis points last year. They are now 25 basis points, which rolls on to things like term deposits, bond yields, all those sort of things. The levels of income are very low. Indeed, when you adjust for inflation, when you look at this next slide here, you can see that interest rates are basically in negative territory in real terms. What do I mean by real terms, or real earnings on $1 million? Well, real means after allowing for inflation, the consumer price index. That's still been running around 1.6%, 1.7%, and with interest rates now well below that sort of level, even at the end of last year, this slide is the end of last year, you're actually going backwards if you just invested into overnight cash or even a term deposit. Your earnings were unlikely to exceed inflation. In fact, we're going to be less than inflation, so you're really going backwards, and that has only got worse this year. And added to that, we would expect inflation to actually drop a little bit. You obviously seen some big falls in oil prices, and those are starting to flow through to people, but we still expect inflation to be positive. So moving on, I think the next two charts, or particularly this chart here, I think is quite relevant to consider the current environment. Now, you may have seen this chart before, and I say we did go through this chart in some detail a couple of weeks ago on the previous webinar, but this chart looks at the income you would get from a, well, in this case, $100,000 investment put into the Australian equity market way back in the start of 1980, or if you like, the end of 1979. You invested $100,000 into, we actually used the All Ordinaries Index for the first 25 years, and then an index became available that grossed up for franking. We used that, switched to that index afterwards. So what this does is, though, the light blue line, which starts at about $5,000 and finishes at about $70,000, or just above $70,000, is the income stream that would have been generated from that initial $100,000 investment in the All Ordinaries Index, under the assumption, and this is an interesting one, that you did not reinvest the dividends back into your investment. You actually just held the initial capital value. You owned the shares, but you never sold any of the shares, but you never contributed the dividend income back into the market. This stream is grossed up for franking credits, so it's gross dividends means gross, including franking credits. And so that initial $100,000 investment would have generated quite a significant amount of income over the last 40 years. And but the important point I wanted to note about that were the two periods of sort of recession or financial crisis. We have a period, the recession we had to have, which was in sort of 1990 through to 91, or even maybe early 92 before the markets really rebounded. And secondly, the GFC, which we're all probably more familiar with, which was in 2008, although there were some warning signs around the end of 2007, 2008, 9. You can actually see that the dividend stream isn't constant. It has drifted up over that, gone up considerably, but it did fall around 30% over the 3 years in from the peak in 1989 through to 3 years later in 1992. It was just over a 30% decline in that dividend stream. Remember, this is a dividend stream from the whole market in sort of dollar value. And again, it fell around just under 30% in the 2 years of the GFC crisis. So you actually had sort of dividends falling across the market for 2 years, although the most of that dividend fall was in 2008. And so you saw that those sorts of levels. So we're talking about 30% declines across the market, and that's quite important. I think it's probably not as instructive to look at the next slide, because the next slide looks at the capital values, but you can see that particularly in the GFC, there was a much sharper fall in capital than there was income. So whilst income levels fell about, just under 30%, the market peak to trough fell around 50%. This is actually calendar year December 07 to December 08. was about a 40% drop, but actually from the absolute peak to trough is about 50%. So capital values often exaggerate the swings in actual dividends. Dividends only fell around just under 30% in that period. But this is an interesting backdrop to consider what potential impact may have of the current crisis and the likely recession that we are in. We are already on record to saying we expect similarly something like a 30% dividend decline across the market from what we can gather at the moment. So let's look at what now let's look to the present and our expectations of what COVID has for dividend income for retirees or other investors. You don't have to be retirees. Now, what we've already seen is quite an unprecedented period where a large number of companies, many of them quite small, but a large number of companies that have already announced dividends have made decisions to either not pay them at all, to cancel them, or to actually defer them and pay them at a later date. Many of these are small companies, and many of them are companies that we didn't own. When it says not held, it meant that it wasn't owned essentially by PL8. PL8 actually invests in the Plato Australian Shares Income Fund, and that fund, any stock there that's got not held, we didn't own in our portfolio, but we had some small holdings in Northern Star, a gold miner, NRW Holdings, a contractor, Qantas, obviously the airline, which had been quite profitable, had announced a buyback and a nice dividend, and within a month of that announcement has actually decided not to withhold the dividend and pay it at a later date. They're now talking September, and to not do their buyback. And Super Retail and Harvey Norman were other stocks that we held that actually fully cancelled those dividends and decided not to pay them. Harvey Norman is very interesting because it decided not to pay that after it actually went ex-dividend, only a week or two back. Another one that's actually subsequent to doing this table, you may have seen yesterday that Sydney Airports has decided not to pay a distribution in June this year. So obviously airlines are grounded and airports are not making any revenue. So this is pretty much unprecedented to see these level of dividends being either cancelled or deferred, or in a couple of cases sort of reduced after they've been announced. We've never seen it. It didn't really happen in the GFC, but clearly we are in interesting times. We also look at where there may be future cuts. So we're looking at the top 20 stocks really on this next slide, where we see the dividend risks and where we see low risk of dividends, or essentially we expect dividends to be maintained or even increased. And even though you might think China was the first one that went into the COVID virus, and indeed it emanated from there, we are still very positive for the outlooks of BHP, Rio and Fortescue, which are big iron ore miners here in Australia. And whilst BHP and Rio do other things, their main profits come from iron ore these days. Iron ore prices have held up very, very well over the past 3 months, and indeed in Australian dollar terms, they've probably actually risen. That's partly because of a number of factors. One is that Chinese steel mills are still producing at high levels. There have been some supply issues around the world. There's been bad weather in fact in Western Australia, but also in Brazil. So Vale is actually exporting less iron ore than it normally does. And there's actually been some closures in South Africa and other countries because of COVID. So supply has been reduced, and Chinese steel mills are still producing significant quantities. And we expect that China will need to continue to stimulate its economy. The Chinese GDP number actually came out at -6%, which was a pretty big number for China, because they generally only ever see positive numbers of about 6 or 7%. So that was a real indication of what happens when a country's go into lockdown. But we expect China to continue to invest significantly in infrastructure, which means that there will be demand for steel. Telstra is obviously benefiting from telecommunications and other things. It has actually already cut its dividend nearly 50%. We don't expect it to cut it in the near term. Woolworths and Coles are not in the top 20, but it's similar to Woolworths. Obviously, their sales are booming as we all stay at home and consume more and buy more from grocery stores and don't eat out. And CSL is actually performing very well, obviously in the healthcare industry. so we see very little risk, if you like, of dividend cuts there. And in fact, there may be some increases. In the medium level risk, whilst the banks are likely to cut dividends, we see the least risk with Commonwealth Bank. It's well capitalised, arguably the best capitalised bank in the world. It's just paid a big dividend, and it's sort of probably a better cycle than the other banks, given that it's just paid one and it'll be 6 months before it's got the next one coming up. Macquarie's actually, and Wesfarmers, we think are fairly low risk, and we actually topped up some of our holdings in Macquarie Bank recently because it had dipped and halved in value and has bounced back a little bit lately. And less, Suncorp, AGL, IAG, ASX. In fact, I think ASX is unlikely to cut its dividend because its volume is still pretty high. The stocks with the most risk, apart from the smaller banks, but Westpac, NAB and ANZ are certainly high risk of cutting dividends, particularly, and this is a subsequent event to our last webinar, APRA, the bank or regulator, an insurance company regulator, has actually written a letter to all the insurers and banks in Australia, or depository deposit takers, and sort of warned them that they need to be prudent about their capital management and dividends, and encourage them to essentially cut or even defer dividends. But they didn't rule out companies paying dividends, and in fact suggested if they did, they should do dividend reinvestment plans, which is something that we have written to the banks and talked about ourselves, believing that they should still try and pay dividends if they can, because a lot of investors are looking for that income. But I think there's got to be realistic that there's a good chance there will be significant cuts from some of those banks. Obviously, oil prices have tumbled, and in fact, we had a very strange thing called contango overnight, where near-term oil futures in the US actually traded at a negative price. It's a bit of a quirk in that market, but basically oil futures in the US went into a negative price. You could buy a barrel of oil for minus $37, e.g. oil producers are basically paying people to take the oil off them because they got nowhere to store them. So that's an interesting world we're in. And Transurban, it's an interesting one. We all think that roads are very safe and people always drive. Well, they don't always drive if they don't go to work. And so we've seen a substantial traffic volume declines at Transurban. Shopping centres also are under the hammer, which is Scentre Group, and South 32 isn't an iron ore miner, and what it's producing has seen prices tumble. It's also been affected by some of the lockdowns in South Africa. So that's our picture of the top 20. We think that overall we would expect something like a 30% cut in dividends, but there will be some stocks that we've already seen that have cut their dividends completely, which is why we've talked to investors prior. You may have heard us talk about avoiding dividend traps, but I think in this environment it is also even more important to understand the likelihood that companies may cut their dividends completely, and so avoiding those stocks that may have big cuts. Although it's somewhat hard to avoid the banks completely, they are such a large part of our market. We will still own substantial holdings in banks, but we're currently owning less than we normally do. Avoiding the stocks like AMP, I mean, we've used this slide for a while, but we'll probably change that, I think, coming forward. But AMP has been a classic example of a stock it's in structural decline. There are certain issues and problems with AMP, and it has progressively cut its dividend 4 times to nothing. And avoiding stocks like that, where the share price has fallen well over 50%, over 60 or 70% now, is actually very important in A, protecting capital, but B, also you don't want to buy a stock that doesn't pay any dividend at all because it's not satisfying our objectives. So we think it is more important than ever to avoid dividend traps. And we have updated our outlook for income across the asset classes. It's pretty stark now if you actually look at where income levels are, that this was basically at, and the term deposit number is actually the 29th of February because it does a bit of a delay there, but you see very low levels of interest rates on cash, bonds and term deposits, sub that inflation number. MSCI World, whilst markets have fallen, you normally say yields have risen, but we are factoring in around a 30% cut in global dividends as well. And similarly, we have the same sorts of numbers on the Australian equities and REITs, whereas the historic yields are actually higher than that. We think when you factor in the chance that stocks will cut dividends, that the gross yield on the Australian market, including franking, our expectation is that using end of March share prices, that the dividend yield in the following 12 months will be about 5% on the market, which is substantially lower than it, or quite a bit lower than it normally is, which is around the 6% level. And indeed, given the fall in share prices, if dividends weren't cut, we would expect the yield to have risen to 7%, but we've got it at 5%. So given that environment and outlook, we've got to, if we look at our market outlook, the virus is being controlled. I mean, in Australia, we're certainly well ahead of the curve now. It's very clear that the self-isolation is working, but I think it'll be still a few weeks before we start to reopen the economy, and it will be a long time before probably we open up our borders to tourists and people from overseas. We think a recession is unavoidable, even though the government is spending a lot of money to keep people in jobs and job keepers and increasing New Start. The level of fall off in sectors like travel, tourism, education, restaurants, and those sorts of things means that it's very hard not to see the Australian economy going into a full-blown recession, the first since the recession we had to have. Government policies will be crucial in how we limit that downside, and those include policies to reopen the economy. As I mentioned before, we are very strong in our views that interest rates will remain even lower for longer, and so you better get used to sub 1% interest rates. And but realistically, many dividends will be cut. Some already have been cut, and it will vary a lot from sector to sector, as my discussion talked about. We think the grocers and the iron ore miners will still be paying good dividends, but other sectors may not pay any for a year or two. We think that means the case for active management has never been stronger, and particularly avoiding dividend traps is incredibly important. What is the impact of that then? So directors had a meeting a couple of weeks ago to discuss the dividends, and at that meeting, the board resolved to reduce the dividend paid from half a cent a share to 0.4 cents a share, or $0.004 a share from April to June. We thought that was a prudent decision given the current economic conditions and the expectations of the dividend cuts, which I've talked about. And there's continuing uncertainty in the economy. We don't know when the lockdown will be lifted. It will be lifted, but we're not sure when and how that will occur. So we think it is prudent to do that. I think it's important to emphasize, though, that our portfolio is highly liquid and diversified, and there's no issues there. We do believe that it is that is prudent to cut those, or to reduce or trim the dividend. But we also think it's important to continue to pay a regular monthly dividend, because for many of our investors, that's the money that you live off in retirement. So we think it's a key objective of our fund or our listed investment company, Plato Income Maximizer, is to pay those regular monthly dividends. So that's all I had to present, but I am happy to take some questions. And there have been, you are able, if you click on the Q&A button, some of you already have worked that out, you can actually type in questions and we'll be happy to go through some of those. I might hand back to Amelia and to coordinate those.
Of course. Thank you, Don. It's always great to get your views on income investing and on the outlook for company dividends during these extraordinary times. So as Don said, a reminder, we do have the opportunity for investors to ask questions, and this can be done by clicking on the Q&A button on your screen. We have had quite a lot of questions come in, so we'll summarize the most popular ones. And if we don't get to yours, we will certainly come back to you on email. So Don, a couple of questions with regards to if we see a period for top 50 stocks not paying dividends, what will the fund's payout profile look like? What are your thoughts on this?
It's difficult to envisage that the whole top 50 will not pay dividends. I mean, it is a risk that the financial institutions that are regulated by APRA may take a very conservative route and take APRA's guidance and pay no dividends for a period of time, and they're only talking about deferring them for a period of time, not periods of time. But I think in other areas, we mentioned a few companies where we actually think that there may even be potential for dividend increases, and that's the likes of BHP and Rio and Fortescue, Woolworths and Coal's not in the top 20, but it is in the top 50. Those sorts of stocks we think are still doing very well. CSL's doing well. It's a very small yielder though. That doesn't mean it. So I think it would be very tough for us to see no dividends in the top 50. That would be an absolute extreme. We would have to be in a very dire situation for that to happen. I mean, it's interesting to look at the GFC, which technically wasn't a recession here. We sort of managed to eke that out, but there were actually some companies that increased dividends during the GFC. So it was a tough period, particularly for financial stocks. But there were some industrial stocks, etc., that increased dividends through that period. So, but clearly the board would have to look at how much dividends it paid out if there was a significant contraction in dividends paid by the whole market. But I can't see all stocks in the top 50 not paying a dividend.
Thank you. I guess following on from that question, one of our audience members has asked, what is the outlook for bank hybrid dividends, in your opinion?
Look, I'm not an expert in there, but but at this stage I have no. Well, yeah, I think I'll pass on that one. I'm technically trying to think whether if the bank doesn't pay a dividend on its normal stock, whether it can actually still pay on hybrid. So I think I will take that on record and do some homework on that. We don't invest in hybrid, so we're not experts in that field.
Another few questions we've had around looking ahead to when the virus is no longer a threat. The government will no doubt be looking for new ways to pay down the huge debt that it has created, and the issue of excess franking credits could well be back on the agenda. What impact would this have on PL8, and what strategy would you employ to minimise its impact if it was to eventuate?
Yeah, I mean, I've heard the Prime Minister has been asked this sort of question about whether they'll consider changes to franking credits, and his response was no. Now, obviously, there may be new governments in place in the future, but given the extreme, I think, negativity associated with franking credits at the last election, I think that'd be a pretty tough decision for a government to make, particularly across the board. I think if they were to do something on the franking credit front, then they may soften it. And there were two potential areas that we were looking at the time. Obviously, we campaigned a fair bit about this franking credit issue last year. That one is a lot of the refunds. It's interesting, if you look at self-managed super funds or just super funds in general, there are a very small number, e.g. literally only thousands, a few thousand, very large self-managed super funds. And so what I think Rice Warner has advocated is potentially, now there's currently there is a limit of 1.6 million in pension phase super. Rice Warner suggested that maybe we should consider having a limit on the total amount that can be invested in superannuation per person. And that would only really affect a few thousand very large self-managed super funds, but they do tend to get the lion's share of franking credit rebates, even with the current $1.6 million cap. I think that will be quite a nice solution to that. wouldn't affect very many people, and those people affected are very, very wealthy. Alternatively, another suggestion has been that there would be a limit on the amount of refundable franking credits per person, so something like $10,000 per person or 20,000 for a couple or something. So I think if they were to change the refunding of franking credits, they would look to do it in a more sophisticated way, which really targets the quite wealthy. But I mean, I think at the moment we should be worried more about COVID and the current environment than what may happen in a few years' time.
Indeed. Question we have from one of our audience participants, anticipating the reduced dividends from banks. Excuse me. Anticipating the reduced dividends from banks, why not liquidate those holdings and cycle into alternatives until there is a sign of recovery in banking stocks? Don, what's your view on this question?
Well, we actually have some limits within our portfolio, which means that we can, at maximum deviation, and it's the way we've constructed it, but the maximum position we can, or the minimum position we can hold in a stock would be 5% underweight. And some of the banks actually are still more than 5% of our index. So even within our own diversification rules, we wouldn't be able to have zero weight to some of the larger banks, the same as we wouldn't be able to have zero weight to, say, a CSL at the moment. The other thing is that it's all very well to say, let's get out of the banks now because they're going to have a horrible period. They've already had have underperformed, and we are underweight the banks relative to the index. But you know, it's always going to be hard to time getting back into those stocks, and often you know, when the bell is rung, they've rallied 50% or 100%, and you've missed that substantial sort of rally back into them. So it's a tough decision. You know, we think banks, Australian banks, are still very well capitalised and still relatively well profitable, and I think that they will continue to pay solid dividends in the future. But there will be a bit of a pause in those dividends. But even if the banks were to cut their dividends by 30% or 40%, they're still actually trading on quite a high yield, even if they were to do that, because their share prices have basically factored that in. So they are still high yielding stocks, even if they were to cut their dividends by those sorts of amounts. So it's, you know, it's always nice to say we should avoid these sorts of areas, but often markets can move very, very quickly, and timing your getting back in can be quite tricky.
Thank you so much, Don. Look, everyone, we have arrived on our half-an-hour allocation to today's webinar, and we will have to stop there, but we will be sure to reply to everyone who hasn't had their questions answered. We will be making this webinar available on the Plato website, and we'd like to thank everyone for their participation and engagement to today's session. In terms of our next engagement with our investors, myself and the rest of the listed team are here to assist with any further questions you have, and we look forward to communicating via our next webinars as we aim to keep you informed during these changing times. I'd like to thank Dr. Don Hamson for your presentation today and wishing everyone a great day. Thank you all.